Right, lads and ladies, today we're going to run through what is trading. I'm going to break it down. I'm going to keep it very simple. We're going to try to keep these videos short form, 10-15 minutes max, so you can get in, get out. The course is available online. I'll leave the link below. The aim of the video is for you to be able to match a 10-minute video that's going to describe and explain what the course is. So the course is just a long form explaining everything, and where the videos are kind of more snappy, get to the point, and help you understand what's in the course. So I'm going to bring it back to basics. What is trading? When people think of trading, they think of nice suits. They think of men shouting at their screens on a New York Stock Exchange trading floor. And in reality, it's not like that. Not anymore. It used to be like that back in the day. You see it in movies and stuff, but it's not like that anymore. Now it's much more simple, a million times more simple. Anybody with a connection to the internet and the phone can trade, and it's that simple. But if you break it down and find the actual definition of trading, trading is the act of buying and selling financial assets like stocks, currencies, or commodities with the goal of making a profit from the change in price. Now, if we strip it back even further, before we had currencies, before we had commodities, before we had stocks to trade, we used to trade by barter. So if you break it right back and break down what trading actually is, back in the day, when your grandfather's grandfather was a young man, you used to trade. You didn't have gold, you didn't have silver, you didn't have currencies. What you had was animals, or you had livestock. So, for example, if you wanted 2 goats, you may give somebody a cow. That's the act of trading, exchanging one thing for another with some sort of value to it. So when you bring it right back then, and we look at how we've progressed, we went from trading with barter, which is your cow for 2 goats, and then right, well, a cow is big, and some people don't want a cow, and some people don't want a goat, and who wants a pig rolls around in their own shit all day? Do you know what I mean? You want a cleaner and easier way to transact. What we then started using was gold. So if you wanted a cow, you'd give a certain amount of gold, and this fella give you a cow, or whatever it may be. And then what happened was we started using gold, and then we start backing our currency. Fiat currency is just a currency that is backed by government promises. So fiat currency is, every currency in the world is a fiat currency. The word fiat comes from let it be done, or let it be made. And it's basically just a currency that's backed by what the government tell you. If government tell you that €1 will buy you 1 loaf of bread, that's what €1 will buy you. If the government tell you that €1 will buy you a house, that's what the €1 will buy you. It's not like gold where it was backed by a hard physical asset. And it's different now. And that's why assets like gold that hold their value, they tend to always hold the value even when fiat currency declines, because it's a safe haven. There's a certain amount of it. You can't keep printing gold, and then you're going to have more gold than there is supply or demand for the gold. You're never going to have that issue with gold, because you can't just keep printing more of it, whereas you can with fiat currencies. They find that gold and other commodities are great safe haven assets. So now when we think of what is trading, we know what it is. We've dialed it right back. We used to trade by barter, your animals, and then we progressed from there. We went from trading animals to trading with gold, and now we're trading with fiat currency. It's the same thing. The transaction is the same, and it's important to notice that, because you think, oh, these flash numbers up here to the side, and oh, what are these numbers and all mean? It can be real intimidating, but it's really simple. It's just, in the end, you're just exchanging one thing for another. And although the digits are moving and they're flashing green and red, and it's not as difficult as people make it. When we look at what we can trade, if you look at the sidebar here, we look at what we can trade. The main things we can trade are, you can pretty much trade anything. You can trade the price difference on anything. But what we focus on are currency pairs, and then they're broken down. You have your currency pairs, and they might be broken down into major pairs like the Euro USD, GBP USD, GBP JPY. That's the pound versus the yen. Or you might have some sort of minor pairs, like we have a look here now. You might have minor pairs like Euro GBP, and then you might have some mad exotic pairs that nobody really trades, like the South African rand against the ruble. Do you know what I mean? Or the yen against the rupee, or something like that. Something that nobody really trades. Do you know what I mean? But you want to be trading where the volume is. Why? Because that's where the volatility is. That's where the price movements are. And that's how you make money on those price movements. Other things you can trade are commodities. You have gold, silver, copper, platinum is what we have up the side here. You have your oil. You have some other commodities that people don't actually know are commodities. You have sugar. You have coffee. You have wheat. They're all types of commodities. Again, don't get intimidated by how can you trade sugar. It's not. It's the same thing. You're just trading the two things. Only instead of you taking holding the sugar, you're just trading the price difference. Do you know what I mean? And hope everybody's with me. And then we work up the indexes. Indexes are slightly different because you're not trading one thing against another. You're trading the price of an index. So all an index is a group of companies that are listed on a stock exchange. In this case, and so the S&P would be the top 500 companies in the US, all put into one index and displayed at one price. The Nasdaq is the same thing, but it's top 100 tech-heavy companies, and same thing pushed together and they spit out a price for that index. So if you want to gain exposure, if you don't want to gain exposure to, all right, but I don't know whether to invest in one of the magnificent seven, invest in the S&P or the Nasdaq, and you'll get exposure to all of them. The Nasdaq and the S&P are important because they have, what's the word? They have, you can estimate their gains they're kind of reoccurring down 8 to 10% annually. So you're kind of secure in an index. Then you have other indexes like you have US 30, that is just US 30 is just top 30 companies. Then you have the German 40, that's Germany. You have the CAC is France. You have the FTSE is top 100 companies in London, in England, the UK. And then you have the Dixie. So the Dixie is not an index. Well, it is, but it's an index that's made up of other currencies. So it weighs out the strength of the dollar against another currency. So if you know that the dollar's going up, it's safe to say that something linked to the dollar is probably going to go down or up, depending on what period you're trading. It's important to understand as well that it's a vast market. It's a vast market. $7 trillion are traded within the foreign exchange markets, just the foreign exchange, just currencies, every single day. So when you look at it in that perspective, it takes 11 days to count the 1 million. It takes 21 years or something. I must check it. 21 years, I think it is, to count to 1 billion, and then to count to 1 trillion. Then you're talking what, another 1,000 years onto that. 210,000 years. Find out right now. So there's a broad market. You don't have to be the one making all the money. You just need to follow the big fish. The banks and institutions are what drive the market. So you just need to be following behind. To count to 1 million, 11 days, 31 years to count to 1 billion. So 31,000 years to count to 1 trillion. 1 trillion, 31,000 years. 7 trillion gets traded within the foreign exchange markets. What's that? 210,000 years it would take you to count to the number, the digit that gets flown through these markets each and every single day. It's important. It's a big number. It's a big number. There's money to be made, and there's money to be made for absolutely anybody from any walk of life, whatever background you have, whatever situation you're starting with. Now, what else? We're going to try to keep these videos short form just so you can understand and get on to the next one. Nobody likes seeing a video that's 10, 15, 20 minutes long. You're just more reluctant to actually sit down and watch the video. Do you know what I mean? We're a 10-minute long video. You sit down while you're having your breakfast and watch it. Now, the way we make money off of trading, say, just for example, we have this currency period. We go to clear data feed. And like that, you can trade whatever you like to trade. Some people like to trade indexes. Some people like to trade commodities. Some people trade only currencies. It's whatever suits you. It's kind of whatever you feel comfortable trading. Is there anything on this? That would break your heart right there. I missed this trade. That would break your heart. 3,800 pips. Break your heart. But we are essentially just, how we make our money is if we think price is going to go up, essentially, in its easiest term, you want to buy low and sell high. And if you think it's going to go down, you want to sell at the top and get out of your position at the bottom. And it's that difference in price is how we make our money, is essentially betting that the difference that the price is going to go up if you're entering into a buy or a long position. And if you think the price is going to go down, you're going to enter into a sell position or a short position. And that's where you're going to make your money. It's important to understand what trading is before you get into it. If you go into anything in life and you don't know anything about it, just going to go in and gamble. It's very easy to go into this now and press buy on your MetaTrader or press sell just for the sake of it, and you lose your money, and that is gambling. And that's what gives the whole industry a bad rep, so to say, because everybody will say it's just gambling. Oh, you don't know what you're doing. But the way I look at it, if you sit down at a blackjack table, poker table, whatever it may be, with a card counter, somebody who can something that you can't do, you're gonna lose. Why? Because they have that edge. They have that one up on you because you can't understand how the card count. Whereas when people are saying, "Oh, that's just gambling," and all, they don't understand what's on the screen here in front of you. They don't know what this is. Do you know what I mean? So it's easy to go in and say, "Oh, well, you're gambling," but if you know what you're looking at, essentially, if you can card count with a chart, you know what you're looking at, you know how to read it, but then it does give you an opportunity to catch positions like this. Do you know what I mean? But that's that. Just a short quick video explaining what is trading, what you can trade, how we make our money off trading, and just keep it very short form. The next video is going to be tips, and you'll find with this series now we're going to break down, before we get into the technicals of how to read a chart or how to understand fair value gaps, order blocks, equilibrium, stuff like that, daily biases. We're going to understand what it is, the risk management behind it, and how to understand it fully and wrap our heads around it fully before we start going in. Because if you don't understand it fully, well, then you are essentially just gambling.